Hey everyone, I'm so glad you could join me for this explainer today because we're tackling a topic that literally every Canadian has been feeling right in their wallets. I mean, if you've opened an insurance bill anytime in the last 6 years, you've probably experienced a very real, very collective sense of sticker shock. It feels like whether you're insuring your family car, your house, or your condo, the numbers at the bottom of the page just keep climbing year after year. And it's not just in your head. The data absolutely confirms that between 2020 and 2025, the cost of Canadian insurance has fundamentally shifted. So, the million-dollar question, maybe literally, is this: why are our insurance premiums absolutely skyrocketing? It is incredibly frustrating to pay more for the exact same coverage, especially when basically everything else in life is already getting more expensive. But today, I'm going to be your lead investigator. We're going to push past all that frustration and uncover the actual data-driven reality behind these staggering costs. We'll break down exactly where your money is going and what invisible forces are pushing those premiums higher.
Just look at the contrast here. It completely validates that pain we're all feeling. Between late 2019 and the end of 2025, general inflation, your everyday stuff, went up about 21%. Passenger vehicle insurance premiums outpaced that a bit, climbing 23.9%. But then, check out that last number. Homeowners' home and mortgage insurance premiums have skyrocketed by a whopping 45%. Yeah, you heard that right. Homeowners' premiums are rising at more than double the rate of general inflation. To understand why, we've got to look at our first major driver.
Culprit number one, the climate toll, specifically extreme weather claims.
$8.6 billion. Just let that number sink in for a second. That staggering figure represents the cost of catastrophic extreme weather claims in just the single year of 2024. For some context, we're talking about events where the claims exceed $30 million per incident, massive floods, devastating wildfires, and severe storms. 2024 was the absolute costliest year on record for these kinds of claims in Canada. But as you'll see in just a second, this wasn't just some crazy one-off bad year. Looking at the timeline from 2020 to 2025, obviously 2024 sticks out like a sore thumb at $8.6 billion. But the truly wild part? Every single year on this list actually ranks among the top 10 costliest on record for extreme weather in Canadian history. Even the so-called lower years like 2020 and 2025 are hovering around $2.5 billion. The sheer volume and intensity of these extreme weather events have created a totally new and very expensive baseline for property damage.
Which brings us to culprit number two, the cost of rebuilding.
Because when extreme weather wipes things out, somebody's got to pay to build it all back. And here's the direct fallout. Amid that massive spike in catastrophe claims, the overall expenses that insurers incurred for homeowners insurance hit an all-time high of $13.2 billion in 2024. The extreme weather is triggering the claims, sure, but the actual cost to fulfill those claims, that's being turbocharged by the broader economy.
It's honestly like a perfect storm of economic factors. You've got higher construction costs, global tariffs, and persistent labor shortages all stacking up. Between late 2019 and late 2025, home maintenance and repair costs jumped 19.1%. But the absolute kicker is the Residential Building Construction Price Index. It surged by an unbelievable 69.4% over that same window. So when an insurer has to cut a check to rebuild a fire-damaged house today, it costs nearly 70% more to build that exact same structure than it did just 6 years ago. And those soaring expenses, they get passed right back to you.
All right, let's shift gears to culprit number three, the auto chaos.
The auto insurance market has been a total roller coaster lately. During the pandemic, 2020 to 2022, we actually got a bit of a breather. People were stuck at home, driving way less, fewer accidents, so insurer expenses hovered safely between $12 and $13.3 billion. It was a brief moment of relief. But then, bam! 2023 hits and expenses rocket to $19.3 billion, peaking in 2024 at a staggering $23 billion before settling just the tiny bit at $22.1 billion in 2025. That is a rapid, explosive surge in just a couple of years.
So what actually caused that massive explosion in costs? Well, it's really a three-part problem hitting the auto market. First off, the vehicles themselves are just way more expensive now. Second, and you've definitely seen the headlines about this, auto thefts across Canada have absolutely skyrocketed. When entire cars vanish, insurers are on the hook for massive payouts. And third, if a car isn't stolen but just dinged up, fixing it costs a fortune. Between December 2019 and December 2025, auto parts and maintenance jumped 22.6%.
Modern cars are basically computers on wheels now, right? Replacing a bumper isn't just swapping out plastic anymore. It involves recalibrating sensors, cameras, the whole shebang. And those pricey replacements pass the cost right back to drivers.
Which leads us to point number 4, the reality check on the insurers themselves.
Now, it's super easy to look at our bills and just assume this is pure corporate greed, right? Insurance companies just padding their bottom lines. But the data paints a way more complicated picture. Take a look at this quote right from the source material. For many insurers, the third quarter of 2024 was the worst on record, as their total expenses rose $3.8 billion from a year earlier. That dramatic fact shows us that extreme weather and sky-high repair costs are severely hammering the insurers too. It's an entire ecosystem under really intense financial pressure.
To put that into perspective, zero in on the third quarter of 2024 here. Insurers brought in $21.6 billion in total revenue. But in that exact same quarter, their total claims and expenses were $21.4 billion. That margin is practically non-existent. When almost every single dollar coming in the door has to immediately go right back out to cover historic disasters and hyperinflated rebuilding costs, it starts to make sense why premiums across the whole industry had to adjust so aggressively. The math literally demanded it just to keep the system afloat.
We've seen the data today. We know that a near 70% jump in building costs, rampant auto thefts, and multi-billion-dollar extreme weather events are the invisible forces inflating our bills. We obviously can't control the weather, and this kind of volatility, it kind of seems like it's here to stay. So as you look ahead to your next renewal notice, I want to leave you with this provocative thought. As extreme weather becomes our new normal, how much more are we willing to pay to weather the storm? Thanks for learning with me today, everyone. Keep asking great questions, and I'll catch you in the next explainer.